The popularity of bridging loans has increased dramatically over the last 12 months. But what is bridging finance? In this video, I'm going to give you a rundown on everything that you need to know about bridging finance. My name's Gindy, I'm one of the senior advisors at Create Finance, so let's get into the video. So what is a definition of a bridging loan? A bridging loan is a short-term finance secured against the property. Effectively, it's designed to bridge a gap. Let me give you an example of when bridging finance may be relevant for a purchase. If you're buying from auction, as soon as the hammer hits and you've won the auction, you have 28 days to complete on the purchase. Now with bridging finance, because it's super quick finance, it gives you the best possible opportunity to secure that purchase. As with bridging finance, you can actually start an application and complete within as little as 5 days. And here's a few more quick facts on bridging finance. The term of the loan is anywhere between 1 and 36 months. So remember, it is a short-term loan. With most bridging lenders, you would typically require a 25% deposit. And with a bridging facility, you can actually put a facility in place where you have no monthly payments. This is because the initial facility can be set up where the interest is either rolled up or deducted. This can help with cash flow and any potential marketing period that you have. If the interest is deducted or rolled up, when you refinance to a traditional mortgage, you'd pay back the initial facility that you borrowed plus any interest and fees accrued. As well as buying from auction, bridging loans are also advantageous when you're buying a property that is classed as unmortgageable. Now this may mean if the property is suffering from subsidence or it doesn't have a kitchen or a bathroom. If you found another property to buy, but you've not sold your current main residence, what a bridging lender can do is potentially take a charge over the existing property plus your new property. When the existing property has been sold, this will then potentially allow the full facility to be repaid. There are a few things to remember. Bridging finance is short term. You do need to have an exit strategy in place to repay this debt. So even if you're having the facility in place for 12 months, 24 or 36 months, the lender will want to know what your exit strategy is. Examples of an exit strategy could be a refinance onto a traditional mortgage. It could be that you're waiting for some other assets to sell, main residence or investment properties. With bridging finance, the interest rates tend to be more expensive. Depending on market conditions, these interest rates can start from 0.5 to 1.5% per month. Annually, that works out between 6 and 18% per annum. Not only is the interest rate expensive, it can be an expensive facility to set up. The arrangement or the facility fee can vary between 1 to 2% of the loan amount. There are valuation fees to be paid as well. Typically, you would need to pay for legal fees for the lender, as well as paying for your own lender legal fees. Lender legal fees can vary depending on number one, the lender and your purchase price, but they can potentially go into the thousands. There may also be administration fees and exit fees to pay when you exit the bridging finance. The exit fee can be as much as 1 to 2% of the loan amount, while the administration fees will vary depending on the lender you've gone with. Not every mortgage broker have access to bridging finance. It's important that you speak to a firm like Create Finance who do have access to these products and can make recommendations accordingly. For more helpful tips around mortgages, please check out this video.